following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We welcome you to our 100th show of All Things Money. That's right, we've been on the air for about 2.5 years now, and this is our 100th show. So as I mentioned last week, actually last week was the 100th show, but we wanted to put together something special for our 100th show and had to have some time to go back through the archives and take a look at some of the best shows that we've done and some of the timeless topics that we wanted to discuss. And so we came up with two. We're going to talk a little bit about the improved three-legged stool of financial security, and number two, portfolio construction and the individual investor. These are two topics that are timeless. They don't involve any sort of stock market prognostications or any tax laws that are changing. These are things that I think will hold well throughout time. As we get into the shows for the rest of the year and into 2012, we welcome your comments and questions. A lot of our ideas for the show come from you, our viewers and listeners, so please take down our phone number, which is 252-633-0107. Our email is allthingsmoney@dlblain.com. And you can also visit us on the web at www.dlblain.com. There you'll find information about myself, my firm, way to contact us, as well as archive copies of the show. So without further ado, let's get right into it. I thought we would start with the new and improved three-legged stool of financial security. Now, maybe you don't even know what the old one is. Maybe you're young or you grew up in a household where you didn't talk about this sort of thing. I'll just kind of give you a brief primer of what I call the sort of post-World War II last 50 years of plan for financial security. And kind of as a side note, I think that as we look back in history, the post-World War II era of the United States, from about 1945, 50, somewhere in there, to 2000, that 50-year span is going to be looked upon in history as a very, quite an anomaly. The growth in the U.S., both in terms of world superpower dominance, economic dominance, as well as financial market returns, will be looked on as somewhat of an anomaly. So when you're looking towards the future, make sure that you're not predicating your financial decisions based purely on that time period. And that's kind of what we're talking about here, that as Social Security became more of a prominent fixture in American society, as the large corporation in America became another prominent fixture, people began to rely on this three-legged stool. Social Security, the private pension, and then personal savings. Personal savings, also the stocks and mutual funds and things like that sort of rose into prominence during this time period, and the average individual became more vested in the economic markets that used to be reserved for the privileged and wealthy. Now were available to many more people at a much lower cost, especially after the deregulation of brokerage firms in the 70s. And so you had these three tenets of financial security: was, get your 40 quarters worth of work, qualify for Social Security, go to work for IBM or some big company, get work for 20, 30 years, get a nice pension to retire on, and all along the way, put aside a little bit of your money for yourself. Well, back in the 50s, Social Security, there were just over 8 workers for each beneficiary. Today, there are approximately 3, and it's projected to go down probably to 2 by 2030. And by 2032, benefit payments will exceed the amount of assets that are needed to cover them. Now, we're already in that situation on Medicare, but we're talking about Social Security here. And Social Security was never intended to be retire at 62 and take the rest of your life off. It was the actual description of the law that put Social Security into effect is the Old Age and Survivors Disability Income Act, OSDAI. And it was intended for, the stereotypical widow that was 85 years old and had no money to come in. It wasn't meant for the retiring mid-60s boomer to go play golf all day. Now, if that's what you do, well, that's fine. I mean, it's there. You take it. You were promised that you take that Social Security, but that was never the original intent, and it sort of morphed into this, and it's just simply not sustainable. Number two, of course, was the corporate pension, kind of along the same lines, that the notion that you could work for a company for, say, 30 years and then just take the rest of your life off when the life expectancy for educated suburban dwellers, people that have access to health care and nutritious food, is probably in the mid to late 80s up into 90. It was never intended that these pensions would go on forever. Companies come and go, and there's just no way that they can promise that they will be there forever. And then, of course, personal savings. As you've seen the past 10 years, the stock market, the returns have been very modest, but of course, the bond market return has been very robust. Gold has been very robust as well. And so those are what we term liquid assets, paper assets. Even though gold is a physical asset, if you use the ETF, it's a paper asset. But things that you put your money into that pay interest or some sort of equity ownership or some sort of commodity, personal savings. So we proposed the new three-legged stool for financial security. We did this a while back. We talked about paper assets, income-producing real estate, and ownership in an operating business. The paper assets are essentially the personal savings aspect of the old three-legged stool. We just put a twist on it that it traditionally meant, savings, put your money in a bank, let it grow at, 1%, that sort of thing. Well, paper assets encompasses, a whole world now, as I mentioned, stocks, bonds, foreign stocks, commodities, real estate investment trusts, oil and gas pipeline. These are all financial instruments that your ownership is represented essentially by a piece of paper, and that you receive a regular brokerage statement that tells you, if your investment went up or down, and they pay income and it goes into your account. These are paper assets found in IRAs, 401ks, this type of thing, that you also can set up and save outside of those instruments on your own. So paper assets, and this should definitely be a big chunk of your three-legged stool, a very sturdy leg of the stool. It's very flexible. It does vacillate in value, but it's very flexible and can provide good income for financial security. Well, we'll continue this. We're coming up on our first break. We'll continue after we come back in a few short messages. So for All Things Money, I'm your host, David Blain.